So let me jump right into the quarterly commentary. And I'm just going to start by saying how hard it is to believe how things have changed in the last year. At this time last year, we were just starting to experience the true impact of COVID-19 and how it impacted all of our lives. And it's kind of funny because in writing our first quarter commentary from last year, and we were in the midst of a 15-day nationwide or almost nationwide lockdown. And that was, if you remember, in an attempt to flatten the curve. We actually had experienced at this point a 34% decline in the S&P 500. We were just starting to get our bearings in the new work from home world. And we here at Custom Wealth Management were hard at work rebalancing portfolios to take advantage of tax loss harvesting opportunities, as well as the opportunity to reposition your portfolio to what we anticipated to be the more opportunistic positions in that marketplace. We were also monitoring and evaluating the events that were unfolding globally and trying to peek just a little into the very uncertain future. In preparation for writing this quarter's commentary, we took a look back at the commentary for this time last year. And even with a healthy dose of realism, boy, were we a little naive. A year later, and we're only just starting to come out of the fog. Restaurants in most areas are still at limited capacity, and we at least had the Masters tournament just a week or so ago with a few spectators. Dr. Fauci is still trending in the news, though now he and about 200 million other Americans are at least partially or maybe even fully vaccinated. And right when we were starting to get comfortable with the cryptocurrencies, now we're all Googling what on earth a non-fungible token or NFT actually is. I don't know how many of you have Googled that, but it's worth looking into. It's actually going to be a very interesting, even possibly a piece of a portfolio at some point. Lucky for us, the markets in their efficient wisdom knew these brighter days were to come. As of March 31st, 2021, the S&P 500 has actually clocked its largest one-year price increase in more than 80 years at 78%. And to give that some context, after the 2008 financial crisis, it took the market a little over 25 months to get to that point. And if you go back even a little bit further to the 2002 tech bubble, that same price increase took a whopping 46 months or almost 4 years to accomplish. As we know, much of the S&P 500's gains last year came from a very small subsection of the market. Growth stocks, particularly technology growth stocks, led the charge. If we take into account just the big 6 stocks from last year, Facebook, Amazon, Apple, Google, Microsoft, and now Tesla as part of the S&P 500, the S&P's 18% performance in 2020 drops to 10% when you take those 6 companies out. That's amazing if you think about it. So 6 companies, about 1% of the S&P 500, was responsible for over 45% of its performance. All things considered, 10% still nothing to sneeze at. But if we dive a little deeper, we actually saw 200 or 40% of the 500 companies that make up the S&P 500 finish in the red for last year. Much like the economic recovery, the rebound was not as widely felt as the headlines would lead one to believe. So let's focus on domestic equities for a moment. Continuing its upward trajectory of last year, the S&P was actually up 6.2% for the first quarter of 2021. If 2020 was the year of the tech stock, 2021 is starting to shape up as the year for value. After a much maligned 10-year period of underperformance compared to growth, value stocks are finally making some headway. As of March 31st, large cap value has outperformed large cap growth by a whopping 10.4%. Mid and small cap value are also in the groove, outperforming their growth counterparts by 12.5% and 16.3% respectively. So we've literally seen a complete shift in performances from growth last year to value this year. What's encouraging is that since the March lows, both mid and small cap value have outperformed growth mid and small caps by about 10%. This makes sense as the reopening of the economy will benefit smaller companies. And in the past few weeks, growth has made a bit of a resurgence, but we are still value tilted in the portfolios as their current price to earnings ratios compared to their 20-year averages are significantly more attractive. Where growth is trading at on average 2 times its 20-year average price to earnings ratio, Value on average is trading at just 1.25 times. As expected, sectors like energy, financials, basic materials that often lead during early stages of recovery posted a 30.67% gain for energy, 13% for financials, and 11.27% for basic materials since the beginning of the year. Technology actually lagged all others, posting just 1.94% so far this year. So again, a very interesting shift or change in the markets. Let's move to international for a moment. As the global campaign to vaccinate people worldwide progresses, international markets also saw positive returns in the first quarter. The developed international market was up 3.5%, with emerging markets trailing at about 2.3% for the quarter. In relation to domestic stocks, we're also maintaining a slight overweight to international, with a pretty healthy allocation to emerging markets. This is primarily an organic result of our emerging market position doing so incredibly well in 2020. Most of you know that Artisan performed at about 82% last year. And our belief continues that emerging markets as an asset class is poised to do very well as the global economy comes back online and as the dollar weakens. Again, if we look back at the history books, we know that emerging markets were the best performing asset class 5 years in a row, from 2003 through 2007, followed closely by developed international and then domestic small cap. Turning our eyes towards fixed income, we think there are a lot of challenges ahead in this world. Fixed income, for those of you not familiar with, is also a good way of thinking of, is the equivalent of bonds. As much focus as there is on equity markets having benefited as they have, it seems like everyone is even more engrossed on what's happening to the fixed income or bond marketplace, particularly what the effect inflation might have on yields. And despite the Fed's continued insistence that it would not raise rates for the foreseeable future, the bond markets, really a notoriously fickle and cynical bunch, aren't buying it, as the Barclays aggregate dropped 3.4% in the first quarter. The Barclays aggregate was negative 3.4%. It was appearing, for a little while at least, that bond investors were testing the Fed as Treasury yields started to rise. But the sell-off of these government bonds, pushing prices down and yields up, wasn't coming from domestic holders, but were concentrated during the Japanese trading sessions, with additional selling coming during the London trading sessions. And an astute analyst finally identified that the Japanese commercial banks were selling off their US Treasuries ahead of the end of the Japanese fiscal year on March 31st. And that's because the Nikkei posted its greatest performance in decades, and banks didn't need the income from these bonds to juice up their financials. This sell-off had a domino effect, as we saw both bond and equity markets wobble a bit in late March. As the Japanese fiscal year has come to an end, things have actually stabilized a bit, and we're already seeing Treasury yields come down, with the 10-year now below 1.6% after peaking at about 1.75%. That might sound like small numbers, but that's actually a very big movement, very significant movement in the treasuries. Even though we can explain the rise in treasury yields to an extent, we may be starting to see some slight inflationary pressure with more to come. The latest personal consumption expenditure deflator, which is the Fed's preferred measure of inflation, showed a 1.5% year-on-year increase in January. This is well below the Fed's target of 2% inflation. This means the PCEs, or personal consumption expenditures, inflator could rise beyond 2% for a period of time before the Fed might take action. It is certainly reasonable to assume that we will see this level of inflation as early as the second quarter of 21, particularly with stimulus checks now hitting the bank accounts of so many. But the theory that the economy will start overheating as people buy more than they actually need to in an effort to avoid tomorrow's higher prices seems, at least for the time being, a little far-fetched. That sort of destructive inflation is something we will be keeping an eye on, for if it appears that the Fed isn't going to shut off the tap of easy money once the economy is fully recovered, or another way of saying if they don't start to increase rates. Given the uneven nature of the recovery and the Fed's dual mandate of price stability and full unemployment, it'll be interesting to see how the Fed actually responds. As recently as his March 17th comments, Fed Chair Powell seems to be placing more emphasis on a full economic employment, particularly among demographics that were hardest hit during the downturn. Based on the Fed's stated key indicators and where we are in relation to those marks, it may be a while before the gap starts closing. And despite the Fed's continued insistence that it will be making decisions based on the data, the markets are still taking a wait and see approach. Rising inflation, even in the slightest of the second quarter, will continue to fuel the market's extrapolation of rising rates beyond where we will probably see them go. That's just simply stating that markets tend to overreact on the upside and on the downside. When the markets will eventually believe Chair Powell, that remains to be seen. Make no mistake, we're still battling the spread of this virus. While investors were rewarded in 2020, and handsomely so, many Americans certainly remain out of work. Businesses were shuttered and lives were turned upside down. Though some days it feels like it's 2 steps forward and 1 step back, it's a welcome change to see the world beginning to reopen. You might be planning to see loved ones that you haven't seen in over a year. You might be planning that vacation that you had to cancel, or maybe it's just a night out with friends at a local hangout. And whatever your plans are for 2021, I'm sure, like those of us here at Custom Wealth Management, we have a newfound appreciation for just having the opportunity to be able to do these things again. I want to take a moment and to thank every one of you we've had the honor to work with. And we know, as always, there's a lot of work to be done, and we're honored to be able to do this on your behalf.